Imagine the cruelest version of financial failure. Not a gambler getting wiped out, not a speculator chasing leverage, but a disciplined worker who followed every rule he was taught. October 2001, Buenos Aires. You are retired, middle class, careful. For 35 years, you showed up to the same manufacturing plant, packed lunches, skipped upgrades, saved 20% of every paycheck. You stayed away from debt, left your money where responsible people leave it. In the bank, in government bonds, in a life insurance policy. Your father once described it with that sacred word, families. Trust too easily. Protection. You didn't fail because you picked something exotic. You failed because you picked what everyone calls prudent. Not because it was fraudulent, in the narrow legal sense. Not because no one warned you that markets move. And if this sounds like an Argentine story, that is exactly the trap. People hear a foreign country, a past crisis, an unstable government, and they instantly create distance. Sometimes it looks theatrical. Wheelbarrows of notes, million-unit bills, shopkeepers rewriting prices before lunch. But that image is too narrow, and it comforts people who think they'd recognize danger if it came. This is why so much financial education is worse than useless. It teaches people to optimize inside a stable framework without ever asking whether the framework itself can be altered by force. Not the politically connected, not the institution writing the emergency memo, not the state that borrowed too much, the saver. Look at the pattern closely enough, and something uncomfortable becomes impossible to unsee. In each episode, the public is sold a moral story right before the loss. Stability, responsibility, temporary measures. So no, this isn't a video about panic. It is not a demand that you run into the street and predict the next collapse by date and hour. That shift matters. It changes everything. And this is where most people resist. They want reassurance. Once you accept that, the whole map starts to redraw itself. You stop sorting assets by reputation. You start sorting them by what happens when the unit of account is altered. That is the mechanism we're about to dissect. Not as theory, not as apocalypse theater. A government bond sounds conservative, right up until you translate it into plain English. It is not a vault. It is not a reserve of timeless value. It is a dated promise to hand you back a fixed number of currency units later. Fixed. Those are the two words that matter. Because if the state can't honor its debt in real purchasing power, it doesn't need to openly betray you to beat you. It has three paths. This is why the safest looking instrument becomes the cleanest extraction device in a currency event. Long-term government bonds don't merely suffer during monetary resets. They're often where the reset is transmitted. The government's burden is transferred onto the creditor through time and inflation, not through drama, through accounting. In Weimar Germany, bondholders weren't protected by the fact that they owned sovereign obligations. Bonds maturing in 1923 were redeemed in marks that had collapsed so completely. The notes were worth less than the paper carrying the ink. In the United States, this mechanism looked more civilized and therefore easier to miss. Between 1940 and 1980, holders of long-term treasury bonds lost more than 70% of their purchasing power to inflation. So when someone says, the government will never default, that is not the reassurance they think it is. Of course, it may not default in the theatrical sense. That is exactly the point. Governments usually don't need to default on bonds. They redefine the meaning of repayment. They satisfy the letter of the promise after hollowing out the substance. And the longer the bond, the more exposed you are. Because duration is not just time. It is vulnerability stretched across future policy decisions. you don't control. Now, put numbers under that wager. The U.S. national debt is over $34 trillion. Interest payments alone exceeded $1 trillion in fiscal year 2024. The Congressional Budget Office projects debt to GDP reaching 170%. By the year 2054, under current law, these aren't fringe estimates, they're official figures. No conspiracy is needed here. The arithmetic is severe enough on its own. If debt is this large, and the cost of servicing that debt is already above $1 trillion a year, then the issue isn't whether bondholders will receive checks. And then there is the form of safety people trust even more than bonds: cash. Cash feels like the thing you run to when everything else becomes uncertain. It is liquid. It doesn't fluctuate every second like a stock. It sits quietly in a checking account, a savings account, a money market fund, a stack of bills in a drawer. It feels defensive because it doesn't argue with you. But cash isn't wealth. Cash is a claim on wealth. Since 2008, the Federal Reserve's balance sheet expanded from about $900 billion to nearly $8 trillion. Read that again, in physical terms. Not an increase of 20%, not a doubling, but almost an eightfold expansion in 16 years. If you told an ordinary saver that the monetary base would rise by a factor of 8, they'd have expected obvious inflation everywhere, immediately, but that is where the illusion of safety took root. Consumer price inflation didn't rise by a factor of 8 over the same span. So many people concluded the danger was exaggerated. It wasn't exaggerated. That uneven distribution matters because it changes the psychology of savers. If your bank balance still shows the same, with a number of dollars, you feel stable. If your bond still pays on schedule, you feel prudent. But stability on paper and stability in purchasing power are not the same thing. During a reset, the inflation absorbed by financial assets starts spilling over. It spills into things people cannot postpone, like food, fuel, rent, utilities, and medicine. History becomes viciously clear at this point. In Venezuela, people who kept savings in bolivars were not making exotic financial bets. They were doing exactly what savers are told to do: hold domestic money, trust the system, and preserve liquidity. Inflation reached 1,000,000% in 2018. At that scale, time itself turns against you. A year's salary can become functionally worthless within weeks. Imagine being paid on Friday and discovering by the next month that the purchasing power of that pay has been shredded. Zimbabwe followed the same structure. Different flag, same mechanism. Citizens who trusted the Zimbabwe dollar were devastated. Citizens who moved into hard assets or foreign currency preserved purchasing power. The real issue was simply unit risk. They were storing life energy in a measuring stick. The state could shrink at will. And then Argentina made the lesson even crueler. It showed that even safer forms of cash can be illusions. In the 2001 crisis, bank deposits were frozen, then forcibly converted from dollars to pesos at an artificial exchange rate. This is the pattern most people resist because it sounds too cynical. Until the numbers are placed right in front of them. Bonds can be paid in full and still fail you. Cash can remain visible in your account and still fail you. A fixed income instrument can keep every contractual promise while breaking the economic one that actually mattered. A bank deposit can appear liquid until the exact moment you need liquidity. Exactly what are you safe from? Price fluctuations. And if you still think this is all too extreme, ask yourself a simpler question. If a government faces politically catastrophic default or austerity, and politically obscured inflation, which route has history rewarded, most often. Not the honorable one, but the survivable one. That is the mechanism, not prediction, not panic, just mechanism. Once you see it, government paper and idle cash stop looking like neutral shelters. They start looking like exposure to a decision made elsewhere. Watch who gets sacrificed first when the math breaks. Not the loudest people, not the most connected people. It is always the people holding promises. The people who believed a fixed number on paper was preserved wealth. That is the dividing line most people miss. That is why cash, annuities, and pension streams sit in a specific tier of vulnerability. Along with fixed income insurance products, they are sold as comfort because they remove visible volatility. The statement looks calm, and the deposit is still there. The monthly check still arrives on schedule. The insurance company does not miss the payment, and that distinction is not academic. It is the entire mechanism. If you hand over a lifetime of savings today for a fixed monthly payment for decades, you are not buying certainty. You are locking yourself into one side of a political bargain. The institution keeps its promise in nominal terms, while you absorb the inflation in real terms. Take the arithmetic seriously, because the system does. At 3% inflation, a fixed payment loses half its purchasing power. It happens in roughly 24 years. At 7%, that half-life collapses to around 10 years. At 15%, the structure is effectively predatory for anyone trying to live on it. The company paying you is not necessarily lying. The state is not necessarily declaring default. This is why the phrase guaranteed income is so dangerous. When people hear it emotionally instead of structurally. Guaranteed by whom? In what unit? Under what political conditions? For how long? History keeps repeating this with almost insulting clarity. In post-World War I Germany, families paid life insurance premiums for years, under the assumption that discipline would be rewarded later. Then hyperinflation hit, and policies denominated in marks still paid out. The problem was that the payout could no longer purchase anything meaningful. A family did not lose because the insurer vanished. They lost because the currency underneath the contract disintegrated. In Hungary, in 1946, prices doubled every 15 hours. And the same story happened in Poland. The 1980s delivered the same lesson in slower motion. People contributed through their entire working lives into systems that appeared legitimate, orderly, official. Then their monthly pension arrived with less buying power than a day's groceries. Again, not through theatrical collapse, but through arithmetic. This is the part almost nobody says plainly enough. The system doesn't erode all claims equally. It erodes the claims of people least able to renegotiate. Elderly savers, pensioners, policyholders, retirees living on fixed checks. They're dispersed, and they're slow to react. They trust institutions because they were sold as the reward for a lifetime of caution. So when you hear an industry holds roughly $8 trillion, do not hear safety. Hear concentration. Hear an ocean of future claims denominated in dollars. Hear millions of people depending on a unit they don't control, issued by a system whose first instinct in fiscal stress is not to destroy itself, but silent dilution. Those promises may all be honored exactly as written. Then there is real estate, where people often assume physicality alone guarantees protection. Sometimes it helps, and sometimes it does the opposite. Again, the hierarchy is not simple. A house you own free and clear and live in is not the same animal as a rental property financed with debt and dependent on income streams fixed in a weakening currency. This is where another layer of sorting appears. Real assets are not automatically safe. Real assets with pricing power are different from real assets with trapped income. During the 1970s stagflation, landlords with long-term leases learned this the hard way. Rent checks came in every month, and on paper, occupancy looked stable, but the lease locked income at yesterday's dollars, while property taxes, maintenance, labor, fuel, and utilities climbed in current dollars. Notice the pattern. The loser is not always the one with no assets. Often, it is the one holding the wrong kind of claim on an asset. The pensioner owns a right to future payments. The annuity holder owns a right to fixed currency. That is the deeper class system inside financial stress. There are people who can move with the reset, and people used to fund it. If your income resets upward with prices, you have one kind of exposure. If your debt stays fixed while nominal revenues rise, you have another. Countries under capital controls make this even more visible. People say, "At least I own property." But if buyers can't access financing, or if money can't move freely, if foreign currency is blocked, then the market for that property can seize. A real estate listing is not liquidity, and a building is not a bid. That is the framework. You can't unsee once you see it. The state protects itself, and institutions protect the nominal promise. A retirement account with a large balance may look impressive until you write no under access, and yes, under rules. A house may feel safe until you remember carrying costs, taxes, and maintenance, and the fact that shelter and liquidity are not the same thing. Take every account on that page and write down the exact friction between you and the money, not in general terms, but in actual terms. Withdrawal penalty, tax event, transfer delay, settlement period, market hours, monthly payment, repricing risk, refinance dependency, jurisdiction, counterparty, who signs off, who can freeze, who can gate, who can change tax treatment, who can demand paperwork, right? When speed matters most. This is where people usually discover that what they called safety was really convenience during normal times. The statement arrived on schedule. The app opened instantly. The number looked stable. So, they assumed the structure was safe. But a smooth interface is not the same thing as resilient ownership. Plenty of things feel liquid, right up until many people need liquidity at once. You don't need to predict a crisis to benefit from this exercise. You only need to stop confusing the calm behavior of a system with the permanent nature of its rules. That is the trap. People think they're investing. Often they're just renting optionality from institutions they don't control. And once you have that page, don't redesign your whole life. Do one transfer, a small one, so small it feels almost insulting. Move a fixed amount from trapped or rule-dependent capital into capital with immediate personal control. Not everything, not dramatically, just enough to create a new default behavior. $50, $100. A percentage you can repeat monthly without negotiation or emotion. The amount matters less than the repeatability. The point is not to become heroic. The point is to stop funding captivity by reflex. If your current habit is automatic retirement contribution with zero deliberate review of accessible reserves, then your counter habit is simple. Every time money goes into long lock capital, a smaller pre-decided amount must also go into directly accessible capital. Same day, same calendar reminder. No debate, no mood, no market check. You're not chasing returns, you're rebuilding optionality. That is all. What they called safety was really convenience during normal times. The statement arrived on schedule. The app opened instantly. The number looked stable, so they assumed the structure was safe. But a smooth interface is not the same thing as resilient ownership. Plenty of things feel liquid, right up, until many people need liquidity at once. You don't need to predict a crisis to benefit from this exercise. You only need to stop confusing the calm behavior of a system with the permanent nature of its rules. That is the trap. People think they are investing. Often, they're just renting optionality from institutions they don't control. And once you have that page, don't redesign your whole life. Do one transfer, a small one, so small it feels almost insulting. Move a fixed amount from trapped or rule-dependent capital into capital with immediate personal control. Not everything, not dramatically, just enough to create a new default behavior. $50, 100. A percentage you can repeat monthly without negotiation or emotion. The amount matters less than the repeatability. The point isn't to become heroic. The point is to stop funding captivity by reflex. If your current habit is automatic retirement contribution with zero deliberate review of accessible reserves, then your counter habit is simple. Every time money goes into long-locked capital, a smaller previously decided amount must also go into directly accessible capital. Same day, same calendar reminder, no debate, no mood, no market check. You aren't chasing returns. You are rebuilding optionality. That might look painfully ordinary. It is supposed to. On the first business day of each month, coffee on the desk, log in, move the predetermined amount, record it, log out. No commentary, no doom scrolling afterward, no reward purchase, because you were good with money, just the transfer and the record. Then close the laptop. Boring is powerful here, because the old pattern feeds on drama. People ignore structure for years, then try to solve it with a dramatic trade. Usually too late, usually at the wrong price, usually under emotional pressure. A small automatic act performed before urgency arrives does more for survival than a brilliant decision made in panic. There is another reason this matters. Most households don't get destroyed by a total lack of assets. They get damaged by mismatch. Their money exists, but not where it helps. Their equity is real, but inaccessible. Their retirement account is large, but trapped. Their home is valuable, but expensive to carry. Their cash earns something, but loses purchasing power. Their portfolio says they are secure. Their options say otherwise. That mismatch is where stress becomes forced selling, bad borrowing, and permanent loss. So the practical move isn't buy this or sell that. It is more primitive. Shorten the distance between you and usable capital. Reduce the number of permissions embedded in your financial life. Notice which assets depend on continued political generosity, stable tax treatment, frictionless transfers, or a buyer appearing exactly when you need one. The page will tell you where the fragility is. Your job isn't to solve all of it now. Your job is to stop feeding it blindly. If you own property, do the same thing there. Write down, in one line, what the property must do each month to justify existing in your balance sheet. House to live in. Fine. Say that honestly. Shelter is a use, not a fantasy. Vacation unit, second home, empty lot, prestige address. Negative cash flow. Rental justified by appreciation someday. Write the monthly carrying cost beside it in plain numbers. Insurance, tax, maintenance, vacancy, utilities, HOA. Then, write one more sentence. Who is the buyer when credit tightens and discretionary spending disappears? If the answer is vague, the risk is not vague. It is simply delayed. If you have fixed-rate debt attached to a durable asset, write that too. Not because debt is morally good, because structure matters more than slogans. A fixed nominal obligation behaves differently in an inflating environment. than floating exposure or unfinanced cash drag. You don't need to romanticize leverage to understand arithmetic. You only need to stop putting every liability into one emotional bucket and every asset into another. Some obligations get lighter in real terms, while some assets get heavier to carry. Some safe balances become guaranteed losers after inflation and tax. The numbers do not care about your preferences. And if all of this still feels abstract, reduce it further. Print your last 3 monthly statements and put them on a table. Circle every line item that requires permission, delay, or penalty, or a favorable market to become actually useful. Then, circle every line item you could actually deploy this week without asking anyone. Look at the ratio. It is more honest than your net worth number. Net worth flatters, but access clarifies. Most people have never performed this audit because it feels dull and slightly upsetting. Good. That is usually where reality lives. Not in exciting forecasts, but in dull frictions, footnotes, and account rules. In the sentence that says funds may be restricted and distributions may be taxed. Withdrawals may incur penalty. Transfer times may vary. Transactions may be subject to review. Systemic risk doesn't always arrive wearing sirens. Sometimes it arrives as a policy memo and a locked gate. So, make the habit almost too small to fail. 2 questions. 1 recurring transfer. 1 monthly review of access versus permission. That is enough to interrupt the old reflex. The reflex to judge wealth by balance alone, and to trust labels, to assume that because an asset belongs to you, it will obey you when needed. It may not, and once you see that, you start building differently. Less for appearance, and less for tax mythology. Less for the number that impresses people at dinner. More for resilience, and more for time. More for room to act, while others are waiting for approval from structures they thought were permanent. That shift doesn't feel dramatic at first. It feels almost disappointingly small. But that is how real financial self-defense usually begins. Not with a revelation, but with a repetitive, administrative act that slowly removes you from the easiest category to trap. Look at your own list and be honest. Which line item do you technically own, but practically need permission to use? Picture the ending first, because that is the only honest way to end a conversation like this. Not with a yacht, not with a screenshot of a brokerage account, not with a fantasy that one clever allocation will let you outrun every shock. Picture something smaller. You wake up to a rule change, a withdrawal limit, a tax revision, a pension adjustment letter, an insurance clause you never expected to matter, a property bill that arrives heavier than last year, a grocery total that has quietly climbed again. And instead of feeling trapped, you feel friction, but not paralysis. You are inconvenienced, but you are not erased. That is the promise worth making, because the real victory in a financial system under pressure isn't perfection. It isn't omniscience, predicting the month, the headline, or the exact trigger. The victory is preserving room to move, while other people are discovering that what they owned was really permission. Permission from a bank to access a deposit. Permission from a pension board to keep a payout formula unchanged. Permission from a government to honor a currency at yesterday's purchasing power. Permission from a market to keep valuing a property at a number that only existed in good conditions. When that permission is withdrawn, the spreadsheet still looks intact for a moment. The damage arrives later, in smaller numbers buying less life. So if you have followed the mechanism all the way here, the conclusion isn't dramatic. It is severe. Build a household balance sheet that can survive insult Not one that needs ideal conditions. Not one that needs low inflation, stable rates, or endless refinancing. Uninterrupted institutional credibility and permanent political honesty. One that can take a hit and still let you choose. Choice is the asset. Optionality is the asset. Time is the asset, and the rest is packaging. That means your finish line should become embarrassingly practical. If you lose income for a season, how many months before fear starts making your decisions? If your bank becomes inconvenient, what bills can still be paid without begging for access? If inflation chews through a year, which part of your life adjusts and which part breaks? If a tenant leaves, if a rate resets, if a market closes, if a transfer is delayed, if a benefit is means tested, if a rule changes over a weekend, what actually happens in your kitchen, in your calendar, in your pulse? Those are not pessimistic questions. They are the adult version of risk management, and this is where many people still sabotage themselves. They hear systemic risk and immediately go hunting for the one safe thing, the one bunker asset, the one permanent shelter. But every age manufactures a new false sanctuary. Sometimes it is long bonds, sometimes it is cash, sometimes it is retirement wrappers with penalties attached. Sometimes it is the house that is safe, because at least it is real, even while taxes, insurance, maintenance, and refinancing conditions and local demand turn reality into a liability. Sometimes it is blind faith in a sovereign guarantee. The form changes, but the trap does not. The trap is concentration inside a structure whose rules you don't control. So the practical answer is not to become a doomsday caricature. It is to reduce dependence on any single promise. Fewer heroic bets, fewer all-or-nothing assumptions, less worship of illiquidity disguised as discipline, more layers, more exits, more boring resilience, a little more cash than optimization models say is efficient, because efficiency doesn't calm your breathing during a disruption. A little less leverage than lenders say you can handle. Their tolerance for your risk is not your tolerance for losing sleep. A little more geographic and institutional diversification than feels necessary, because calm periods are exactly when fragility hides best. A little more ownership of things that can reprice, things that can adapt or be sold without asking permission, not because they are magical, because they leave you less cornered. That may sound underwhelming, but real protection usually is. It looks like a separate account with enough runway, enough to cover essentials without forced selling. It looks like knowing exactly which expenses are fixed, which are vanity, and which are survival. It looks like debt terms, read slowly, not glanced over. It looks like understanding whether your retirement money is accessible, whether it is taxable, penalized, or penalized. Checking not only what an asset earns in ideal conditions, but how fast it can become unusable in bad ones. It looks like asking one rude question of every line item. If I need this to protect me, can I actually use it when the system is under stress? That question alone eliminates a remarkable amount of nonsense. It cuts through the sales language. It cuts through the patriotic language. It cuts through the comforting language. Guaranteed by whom? Protected under what conditions? Long-term for whose benefit? Tax-advantaged until which law changes? Stable income? Adjusted for what inflation? Home equity available how? Exactly. If credit tightens and buyers disappear? You don't need a cynical personality to ask these. You need a survival instinct, stronger than your desire to be reassured. And no, this doesn't mean you must live in a permanent state of emergency. The point of understanding the mechanism is the opposite. The point is to stop being hypnotized by every headline, because you've already done the quieter work. You know where the fragility is. You know where the lockups are. You know which assets are there to generate return and which are there to buy you time. You know what can be sold, what can be borrowed against, what can be moved, what can survive inflation better than a fixed promise, and what merely looks solid because the statement arrives on time every month. Clarity lowers panic because clarity reduces surprise. History keeps rewarding that attitude more than intelligence, more than bravado, more than yield chasing. The family that survives a monetary shock is often not the family with the highest nominal net worth the year before. It is the family that can still function after the rules change. The retiree who keeps dignity is not always the one who maximized return. It is the one who avoided being fully handcuffed to a single institution, a single currency path, a single policy regime, a single repayment schedule. The business owner who makes it through is often not the boldest. It is the one who preserved enough liquidity and flexibility to keep making decisions after others became fixed targets. That is why the promise here must stay narrow and honest. I cannot promise you immunity. Nobody can. There is no portfolio that escapes politics, inflation, taxation, policy error, and market repricing forever. There is no allocation that converts uncertainty into certainty. There is no hidden door out of systemic stress. What you can build is a buffer against forced obedience. You can reduce the number of situations where a distant decision instantly controls your life. You can shorten the chain between problem and response. You can keep enough optionality that a bad year remains a bad year, not a permanent break in your trajectory, and that is where compounding actually becomes real, not as marketing, but as lived experience. Small layers of resilience compound, a modest emergency reserve compounds, and lower, fixed obligations compound. A habit of checking legal access, not just paper value, compounds. Diversifying institutions compounds, avoiding one catastrophic lock in compounds. More than squeezing out an extra point of return ever will. The ability to wait instead of selling into distress compounds. The ability to say no to a bad refinance, a bad liquidation, a bad panic decision, a bad guaranteed product, compounds. Survival itself is compounding. Staying in the game with your agency intact is compounding. People hear that and feel disappointed because it lacks drama, but drama is expensive. Financial adulthood is mostly the removal of situations in which you can be extorted by timing. That is what most safe investments quietly take from you. They don't just offer low upside, they remove flexibility. Exactly when flexibility becomes priceless, they make you an excellent citizen of a stable system and a terrible survivor of an unstable one. Once you see that, the objective changes. You stop asking, what is the highest return I can earn if everything behaves? And start asking, what structure leaves me hardest to corner if something breaks? That single shift saves people years. So take the ending seriously and literally. Go line by line through your own life. Open the statements. Look at the account terms. Read the mortgage reset language. Read the annuity restrictions. Read the retirement withdrawal penalties. Read the deposit insurance limits. Read the property tax trend. Not just the purchase price. Look at the maintenance backlog, the insurance, premium, the cash balance, the duration risk, the currency exposure, the refinancing assumptions, the dependence on one employer, one tenant, one state benefit, one market, one institution. Then ask the question that matters more than, how much is it worth? Ask, how fast does this become a trap if conditions change? If you do that honestly, you may not look richer next month. So I'll leave you with the only useful closing question. If the rules shifted on Monday morning, which part of your balance sheet would protect you? And which line item do you technically own but would still need permission to use?